Well, hello. This is Anthony Parent of IRS Medic, and today we might have our best podcast ever. We're going to go for it because we have some extra special guests. We have John Richardson and Keith Ridman with us as well, but we also have Laura Snyder and Karen Alpert, some heavyweights, if you don't mind the word, in international taxation, some true experts who know the facts better than anybody else of what the reality is. Now, there's been a lot of disinformation going out there, and I'll leave you all to your own theories about to why it is that way. But we can tell you that there is a lot of disinformation right now. There's people out there publishing articles claiming that the U.S. tax code isn't all that great, and it's a bad idea to renounce. And hey, look, it's great. What are you complaining about? What's your problems? But something to consider: if that's so true, why are all five of us together? And that's the thing, that actually it's the whole terror of the tax code is why I'm friends with all these people. And while they're on good guests, I've known them for over 5 years, I think from at least 2017. And that's the thing that has really united us about how terrible it is. Now, I want to head over to Laura Snyder here because she conducted a survey for the seat now. Stop extraterritorial taxation. Do I have the acronym right? Stop
extraterritorial American taxation.
Yep. So thank you. So, and Laura, you conducted a survey. To find out how people really felt about the U.S. tax code and the reasons for why people were doing various things. So, can you? And I just want to go to this, and I'm gonna put the link to where people can find the survey. Put that in the super chat right now. So Laura, could you tell me a little bit about what the survey revealed, some of the conclusions that you were able to draw from it?
Yes, sir. Thanks for asking. So in late 2020, our organization, SEAT, Stop Extraterritorial American Taxation, we conducted a survey open to Americans who live overseas and their spouses, and also former Americans, people who had renounced U.S. citizenship. And we published our report in early 2021. And we had 1,564 people who participated in the survey. They came from every state in the United States, and they live in 68 different countries around the world. We got a lot of data from the survey because we asked a lot of closed questions and also a lot of open-ended questions. And so you will see, there is you've got Open Anthony, the landing page for the survey, and you'll see that there's a lot of different elements to the survey. There's an introduction where we explained how we conducted the survey. There's a part where we give the data on the closed questions, where people come from, and the different, so I'm going to open this up so I can remind myself. Part 2, we have the demographic information. We have where they live, what their income levels are, and what the experiences they've had with tax policies, U.S. tax policies, the experiences they've had with U.S. banking policies, namely FATCA and FBAR, the experiences they've had as business owners living outside the United States, the experiences they've had with filing their tax returns, with amnesty programs, with interacting with the IRS. We asked them questions about whether they were thinking about renouncing U.S. citizenship, and if they were, why, and if they weren't, why. And then also former U.S. citizens, people who had renounced, were also invited to participate. So we got their reasons for why they renounced, what the experience of renouncing was like for them. And then we also had a few people who were spouses and partners of U.S. citizens talk about what their experiences are. And so you'll see part 2 is kind of aggregating that data. What percentage had this problem, what percentage had that problem. And there's always a percentage that say they didn't have any problems. You'll certainly see that in the survey.
Yep.
And then you'll also see the comment section. We had a lot of comments from the open-ended questions. And I took all those comments and I organized them in 3 different ways. Wow. One, I organized by the topic, the types of problems people said that they had and types of experiences they said they had. Then I organized them by the state where the participants were from. So you can see what participants from Texas, what they have to say, what participants from California, Massachusetts, Florida. And then the third part is organized by country. So you can see what people who live in France experience, what people live in Australia experience, what people live in Canada experience. And that's lengthy. There you've got, depending on whether you're looking at the topic state or you're looking at about 700 pages of material.
That's what I'm saying. It's not 700 comments. It's under 700 pages.
Yes.
So this is an incredibly detailed, scathing indictment of the current situation. Go ahead, Karen.
Yeah, well, I think this is the real benefit of the survey, and Laura did an amazing amount of work to put this together, but to be able to look at the comments sliced 3 different ways.
Yeah.
It's a wealth of information.
Wow. This is just, it is, these comments, and it sounds like people I talk to. This sounds, wow, this is just devastating. I mean, it's sort of, but yet, so we have this situation here where this is an incredible, detailed, thorough survey of real people's real words. And now, there's a lawsuit going on. And if you're a fan of this channel, we'll be live streaming it when it comes up on December 5th. Is that right? Is that the day? More versus US. And that's a curious case, because in that case, the transition tax is being challenged, and the transition tax is something that applies only to foreign shareholders, or U.S. shareholders of foreign companies, and the Moors are hit with a $14,000 tax. But what's happening is that there is a full court press that we're seeing in the media by pensioned intellectuals to destroy, demoralize the Moors. And, honestly, and you guys filed an amicus brief, correct? Is that right?
Yeah. Yes, we did.
So it seems like, that they don't want, people don't want to talk about this survey. They don't want to talk about what's in it, right? Are they?
Well, some people don't want to talk about it. That's for sure. It depends on who it is, but I would say, generally speaking, it's not, the problem isn't, yes, the survey is ignored or by a lot of people, but my impression is that, and Moore is a very obvious example of this, is that we're just invisible. It's as if we don't exist. It's as if our experiences, we didn't have them. Or if we did, it's our own fault, or we deserved it. But for the most part, we're just invisible. And I think Moore is a very good example of this, because if this case, Moore, and I'm sure John and Karen will have things to say about this too, but this case, Moore, is about the repatriation tax, or the transition tax, and it was intended to target companies operating overseas. But the way it was drafted, it encompassed individuals who own shares of non-US corporations. And so they were hit with these penalties that weren't intended for them, or at least ostensibly weren't intended for them. Yeah. And when they objected, they were ignored. In fact, the Treasury Department categorically denied their existence. They said there are no U.S. persons who own small businesses outside the U.S. Categorically denied their existence.
Wow.
And you see that our existence and our experiences with this repatriation tax are simply, if not expressly denied, are implicitly denied by simply not being acknowledged. And practically everything you see that's written about Moore, you see this, and you see that the plaintiffs, the petitioners in this case themselves, they're individuals. They don't live overseas. They live in the U.S., but they themselves are not corporations. They are individuals. And the whole discussion of the case is as if they were corporations. The whole discussion of the case is, what are the effects of this on corporations, and why the tax needs to be in place for corporations, without a single acknowledgement of the existence of individual shareholders, or the fact that they experience this very differently, that they presumably weren't the intended targets of this law. It's as if none of that is happening or even exists. And you even see that with the counsel for the Moors themselves. They don't take that into account.
Well, and all of the IRS responses are talking about it as if they're corporations.
Yeah.
They don't acknowledge that there's a difference in the way corporations and individuals are treated with the transition tax.
So we're left in a
very,
situation. Yeah, go ahead, John.
a very, very good example to illustrate the point that individuals generally, and certainly Americans abroad, are ignored. I wouldn't even say to marginalize. You have to be aware of the existence of something, I think, but to be ignored would be, if you look at Professor Mindy Hirschfeld's amicus brief in the Supreme Court. I mean, it's astonishing on a number of different levels, okay, on a number, but just focusing on the particular aspect of this that we're talking about. There is only one, the whole thing discusses the history of the Subpart F rules and the transition tax in the context of multinational corporations. The only acknowledgement of there being an individual at all is where they talk about the Chapter S corporation exception to the transition tax. I mean, this brief is so ignorant. It is so depraved for other reasons as well. But what it is a wonderful example of how, although as Laura points out, the Moors are not exactly multinational corporations. That word beginning with an I, they ignore individuals. I mean, they completely ignore this. So we have this thing playing out before our very eyes, when numerically, beyond a shadow of a doubt, the largest number of taxpayers, both in terms of numbers and percentage-wise, who are impacted by this are individuals. Yet the whole arguments are taking place as though individuals don't even exist.
Wow. Well, that's...
And, you know, this to me, as horrible as this is for Americans abroad, is really, I think, a metaphor, if you will, for how the U.S. political system works, you know, as well. I mean, individuals are marginalized. You know, there is it's an extraordinary thing.
Well, I do want to go over to, because there's an article here, and I mean, when we're talking about ignored, reality being ignored, individuals being ignored, here was an article that was put on CNBC, claiming here's why it doesn't make financial sense for Americans living abroad to give up their U.S. citizenship, one expert says. Now, we could probably have a whole podcast dissecting this article, and we don't necessarily want to get into that. We have a lot to get to today. But here's an example of some incredibly bold statements that it might not make sense to give up your, it says here, it typically doesn't make financial sense, and there's a few reasons why. But, you know, and Karen and I were discussing this earlier about how this doesn't actually address reality that they're claiming here. Well, just one little part here that's truly, truly absurd. Is that they're claiming that, well, here's the thing, you don't want to renounce your U.S. citizenship because otherwise you'll have PFICs, and those are hard to, those are really onerous and hard to prepare.
What they're really saying, I think, is you don't want to renounce your U.S. citizenship because you want access to the U.S. financial system.
Yeah.
But if you're permanently living outside of the U.S., accessing the U.S. financial system is virtually impossible. So I'm not sure who it is that they're talking about who's living outside of the U.S. and investing their money in the U.S. But if they're permanent immigrants to wherever they're living, we're talking about, you know, huge capital flows. And it just doesn't make sense. And it may not even be, you may not even be able to invest in the U.S. because a lot of U.S. investment firms are closing accounts when people don't have a U.S. address.
I think particularly, Karen, for American citizens outside the United States, though.
Yeah.
You know, it's actually much better to invest in the U.S. capital markets as a non-citizen. far, far better, right? Because you get all kinds of tax benefits that
Yeah.
American citizens don't. And interestingly, we talk about renunciation and the exit tax. I mean, anybody with a sense of sort of the history of this, right? I mean, these favorable rules for foreign investors came in 1966, and that was accompanied by the first version of essentially the exit tax, right? For Americans who renounce, they're saying, boy, this is such a sweet deal to invest in the U.S. as long as you're not an American citizen, that we better set up, some deterrence to these Americans actually renouncing so they can get the benefit of that too. I mean, this is really amazing stuff.
Yeah,
Okay.
and Laura, you also were interviewed by someone else writing an article, correct?
Oh, yeah. Well, there is, yes, the local France and the local Europe have shown an interest in the survey.
Mhm.
And so they've published a couple of articles at least. I'm not remembering exactly how many now. But yeah, I mean, occasionally we are asked questions about the survey, and there are some articles out there about the survey. Of course, Helen Burgraff has published about the survey. And then we're also asked questions about, other issues pertaining to, how Americans experience tax and banking policies outside the United States. I know that ARRO, the Association of Americans Resident Overseas, they're contacted, from time to time and ask questions about, the Americans' experience outside the United States. Sure. Yeah.
Now, is there somebody from The Guardian who is writing on this as well?
Well, there might be.
Yeah. There's
Yeah.
there's an interview on that. And do you feel that person's going to tell the truth, or do you think they're going to try to create that alternative reality?
I'm pretty sure there's going to be an alternative reality created. I
Right.
hope not, but every indication is that there will be.
Yeah, and I mean, I would say this is that we've seen this from articles published in The Guardian sort of have one agenda, and I'm not sure who's the one, who's the person pushing this. That's really the whole question, and maybe now might be a good time to go over to a quote. John shared this with me, Senator Gillibrand, which this is really hilarious. She thinks Americans denounce. She says denounce U.S. citizenship, not renounce, to escape U.S. taxes. As JFK once said, the great enemy of the truth is not the lie, but the myth. And I mean, this is really something. I do believe Senator Gillibrand did vote in FATCA. She was in the Senate when that occurred. So FATCA is one of the things that has made life, and if you look at the survey, you could see it's made life for Americans abroad completely miserable, and forcing them to renounce. But again, Senator Gillibrand doesn't believe they exist. Again, ignored. And here she goes further, and this is sort of my point is when you read the end of this letter from her, I want you to ask yourself this question: who is the constituency that would want this? Okay. Moreover, I've worked with my colleagues to introduce the Ultra Millionaires Tax Act, which would ensure that ultra millionaires in the top 0.1% finally pay their fair share and would create economic change and fairness that the overwhelming majority of Americans are demanding. I'll stop right there. Where did we find this overwhelming majority of Americans demanding? When I read this, it's just you, Senator Gillibrand, and then then obviously the organs in The Guardian in the same places that are claiming it's great, same places ignoring Americans are saying, oh, well, they're actually clamoring for more of this insanity. And, here's really something here. The bill would create a 30% minimum audit rate for those that qualify. And I don't know where Senator Gillibrand thinks that there's these IRS auditors who could examine these incredibly difficult returns. And I could just tell you from my own personal experience, about half of the IRS field examiners won't touch anything international because guess what? It's too complicated. So that should tell you something. So she's living in a fantasy world. She's living in a fantasy world where the IRS has the staff to actually understand even what this stuff is. And in a fantasy world where they have the assets. And then this is really the thing, that if you're actually in the ultra millionaire in the top 0.1%, you don't really have to pay taxes because guess what? You could do some elaborate tax planning to avoid any taxation. And guess what? You don't need to renounce because you don't have to pay taxes in the US. You're free to do whatever you want. So we're given this things like, well, we're going to go after the really rich people this time for sure. But if you actually read this, this is the same exact argument of the federal income tax of 1913. It was just going to be a wee little tax on the richest, just a tiny little bit on the richest, to pay for every social program that we could possibly have and wish for. We are going to have utopia. But then very quickly the tax ended up applying to everybody.
So
And now, yeah, go ahead, Karen.
if she's upset that the ultra wealthy are using the tax code to avoid paying taxes, why doesn't she just fix the tax code?
Yeah.
Get rid of the loopholes.
Right. Why don't you just do that? Well, per donors would probably have a problem with that, right? The law, we could look at the law as something the law is the tool of the powerful to become more powerful. That's one way to look at this. And it seems that's about right because the ultra rich already have, trust me, they already have their things. And if you are in the 0.1% and you're paying taxes, give me a call. Could you give me a call? We could fix that for you. Easily. It's not that big of a deal to do that. So really, this is just sort of class warfare, where we're going to go after wealthy, but time and time again, it doesn't seem to go on the wealthy, but we go back to, boy, this survey here. Wow, here's somebody. I have no assets in the US. I make less than $25,000 and the US tax system is killing me. But to Senator Gillibrand, that doesn't exist, right? That person doesn't exist. It gets pretty obnoxious. And I think that's sort of the entire, how we're all depersoned. We're depersoned. We're told of a phony reality, and we know what it is. Now, maybe, would this be a good time, John, to go over what the reality is in the specific ways in which the tax code will hammer someone living overseas with assets overseas, how it will punish them? Would this be a good time now, John?
Oh, if you like, sure. I mean, I think before we get into the specific ways, I think it might be a good idea to review, what exactly the U.S. tax policy is, and, invite either Karen or Laura. But I would, start off by simply saying that the United States is the only country in the world that imposes worldwide taxation, penalties, reporting, etc., on people who not only don't live in the United States, have no U.S. source income, and are actually tax residents of other countries. Would everybody here agree that that's a fair statement of what it actually is?
Certainly. I think it's important, though, to realize that it doesn't hit everybody the same. It doesn't hit people the same because they're overseas for different reasons or because they're living in different countries.
Mm-hmm.
So, if you're just temporarily over outside of the U.S., this is not a problem.
Yeah.
So we maybe call that group here an expats. If you were an expat, you were in the UK for 5 years or something.
Yeah, short-term expat.
Yeah.
Yeah.
And you could certainly, and I think you could certainly find expats who would say, what are you talking about? Tax code's no really big deal. And for those people, it is, and they're not, for them, they're telling the truth. For them, they're telling the truth.
It's not a problem. All
But
their investments are in the U.S. Their retirement savings is in the U.S. They have no problem.
And there is where the banks aren't particularly difficult with respect to FATCA. Some countries, it's very difficult to get an account, or in other countries, it's less difficult.
Yeah.
The main point, though, I think with the expats, I'd be interested whether you agree or disagree with this. But I think the main reason they don't experience this the same way as, say, long-term Americans abroad is because their financial center of gravity and retirement planning is in the United States, right? Would that be a fair statement?
Exactly.
Mm-hmm.
Yeah.
In other words, they don't have to worry about. Yeah, they don't have to worry about foreign, non-U.S. financial products, right?
Right. Exactly.
And also, a lot of them, somebody pays for their taxes to be done. Yeah.
There certainly are some who are that way, but I think more and more are not. I mean, that's becoming, I think, less common, unless you're an executive with a foreign country.
All right, so the expats, our one group, think maybe not short-term Americans abroad, but Americans abroad for a definite finite period of time. They imagine returning to the United States, and their financial and retirement planning is going to be U.S. centric, right?
Right.
Karen, what about these people who are retired in the U.S. and live off U.S. income sources? I tend to think of these as retirees abroad. How
Yeah,
would they
and
experience this?
generally, I think they're going to be all right as well. It'll depend on the tax treaty of the country that they're in, but for the most part, they pay tax on their U.S. Social Security, depending on how much it is, and they pay it to one country or the other. But it's not really a problem.
Isn't part of the thing with retirees abroad, though, that their income sources are U.S. income sources?
Generally, yes.
Yeah.
Yeah,
So I mean,
unless
they're
the
not
treaty
dealing
says
with the
otherwise.
problem of foreign income sources, foreign assets, and things like that, which it seems to me
Right.
create, a big part of the problems for, people who actually, live in these countries and trying to build their lives in these countries. So,
Right.
so there are retirees abroad as one, defined group. And often these people don't have a second citizenship anyway. They're probably not the group who are renouncing. The expats, they're coming back to the United States.
So they're not going to renounce.
Yeah, and then people like, say Karen. I mean,
Yeah.
you've lived in Australia a million years, and as far as I
Yeah,
know, you're
well-
staying, right?
Yeah, I'm staying. I'm here for good. And I mean, Australia is particularly difficult because Australian law says that if you're an employee, your employer has to pay into an Australian retirement account called superannuation. And that's not mentioned in the treaty at all. And nobody really knows how the IRS sees it.
Could you explain why the fact that it's not mentioned in the treaty, why does that matter in the context of the superannuation?
Well, so the superannuation is specific to Australia. So there's nothing in the US tax code that's exactly on point as to what superannuation is. And in fact, there's several different ways you can have your superannuation organized. And each would be treated differently under the US tax code. But also, superannuation is a separate entity. There's actually tax paid inside the account, but that's paid by the fund, not by you, so you don't get a tax credit for that. And then when you start withdrawing, again, it depends on how your super is organized and whether it's treated on the U.S. side as an employee trust, a grantor trust, or whatever.
Well,
And
so to cut through the technical jargon, so in people talk, isn't the problem, okay, that there's no certainty that an individual might not be taxed by the U.S. by the superannuation along the way? There's nothing in the treaty that prevents that?
There's nothing in the treaty prevents that. They'll either get taxed on the way as it's appreciating, or they'll get taxed as they withdraw it. And
but there's no certainty that it is protected, okay, to serve the function that it's intended to in Australia, right?
Right. And in Australia, they're very strict about ability to withdraw before retirement. You basically can't. And but once you turn 60 and retire, so retire anytime after age 60, then the account is completely tax-free from Australian point of view.
But generally, the distribution subject to U.S. tax, right?
But well, depending on what was taxed along the way, yeah.
Okay, so basically, I mean, just real simple people talk. The U.S. tax rules that Americans and Australians are subject to clearly frustrate the intent of the superannuation for Australians.
Absolutely,
right?
yes. They frustrate the intent of super.
Yeah, I mean, and this problem replicates itself all around the world in different ways, right? I mean,
right.
I mean, some examples might be the UK ISA, the Canadian TFSA as some examples. Undoubtedly, there are more. But to go back, Karen, to your, we talked about the treaty. Now, the U.S.-Australian tax treaty is a very old treaty. There are more modern treaties, like Canada.
There are more modern
UK,
treaties. Yeah,
and they provide better protection for this type of thing, don't they?
they do, definitely.
Yeah, not perfect, but better. So, I mean, Karen, would you say that, we look at these people, right? Whether they're expats, whether they're immigrants like you, okay, or we'll get to accidental Americans in a minute, right? Although I think fewer of them are caught into the tax system. Would it be a true statement that your experience living abroad vis-a-vis the U.S. tax system actually depends on what country you live in?
Absolutely. Absolutely. Depends
So,
on what country.
not only are Americans abroad who leave the United States, unlike residents of any other country, except Eritrea, okay, are subject to U.S. tax rules, all right, but the way those rules apply to them is not even general. It depends on what country they live in and what the tax treaty is, right?
And what the tax system is in that country as well.
Right.
I mean, there's those social charges in France that the IRS kept saying weren't income taxes until the tax court said, no, those are income taxes. You have to treat them.
Okay, and why would that be significant? Why would it be significant what the IRS thinks about the social charges? Why would that matter, Karen?
Well, if the IRS says you can't take a foreign tax credit for it, but it's an income tax really, then you're being double taxed on that income.
Exactly. It creates double taxation by disallowing a tax credit, right?
Yes, it did. And if I may add, yes, it did. And there have been, as a result, many Americans in France who had to renounce reluctantly because of that double taxation, because it was a significant amount and they just couldn't do it moving forward. This was prior to the tax ruling, the tax court ruling. So another example.
I'd like to ask a question of Karen and John. What would you say to someone who said, look, this is no big deal. Just invest and save for retirement in the US. What's your problem?
My problem is that in Australia, that's not legal. If I'm an employee, my employer is required by law to create an Australian account, and I cannot take anything out of it until I retire.
I think that's a good answer. And I'll give you another one. I'll give you another one. So let's say that you're in Canada or something, and you want to invest in a TFSA, and they say, well, go ahead and invest in the U.S. Well, Canada's not going to give you a tax-free benefit on that, right? I mean, all you're doing is saying, all right, wow, I'm going to invest in the U.S. to solve my U.S. tax problem, and now I'm going to increase my tax bill in Canada and deny myself of the opportunity to use a government program that's specifically aimed at people like me to facilitate my retirement planning.
Yeah, so whatever is going to qualify for tax benefits in one country is not going to qualify in the other.
Right. Now, as a seat member, Suzanne Herman, I think very succinctly put it years ago, and I've been quoting her ever since, what one country giveth, the other taketh. Okay? And this is why. This is a really, really significant problem. And these, so this idea of, run your accounts out of the U.S., this works for the digital nomad group, who are just sort of running around doing their thing in life, great lives. I mean, they're interested in day-to-day finances, they're not interested in undertaking what clearly in the 21st century is a personal responsibility, financial planning for you and your families. And the U.S. tax code overlaying the tax code of other countries creates a situation where essentially many Americans abroad who can't afford the benefit of fancy lawyers and accountants, and I think, by the way, what these lawyers and accountants can do is actually very minimal, okay? I think they talk a better game than they deliver, okay? But the point is that the overlay of these rules really creates a tremendous opportunity cost, and that opportunity cost is the inability to invest for retirement, the largest cost of all. And this is
Mhm.
what, these people collectively just simply cannot get their minds around.
Well, here's a question for Anthony. Usually he asks the questions. If you live overseas, can you contribute to a 401k?
Well, how's that gonna be structured? Usually you need an employer. So if you need,
Yeah.
you can now, if you are self-employed, sure, you could find a way to do it, but you would probably need an employer. What I'm thinking about as I was listening to you guys is how the US tax code rewrites not just tax codes of other countries, but the employment law of Australia. And then I was
Mhm.
also thinking, really my problem, multiple problems with the Moore decision, but that was a corporation in India, as I recall. And what the transition tax did is it rewrote the corporate law of India, saying that, well, you know what, that what belongs to a corporation is actually what it was is also a dollar for dollar equivalent to the U.S. shareholder. That is, hey, look, there's some retained earnings in there, and I understand that that's other people's money, and that sort of represents what the corporation's doing. But the transition tax went in there and did something bizarre. It pierced the corporate veil. It pierced the corporate veil to say, well, here's this chunk of money that the corporation's using, but you know what? You're a shareholder, so we're going to give you the pro rata share. Now, look, you only pierce a corporate veil, usually in instances of fraud. So it's sort of a curious way that, how the transition tax rolled out is, I guess they're accusing everybody who owns a foreign stock as committing some sort of fraud that allows the U.S. to ignore the corporate law of that country and just say, yeah, that's yours too. That's kind of what I see. And I'm sure that if we look at the other examples around the world, we see the U.S. tax code actually rewriting all of these laws of other countries, denying people the benefit that the law is supposed to provide. And in Australia is a fantastic example. I mean, you have to have, if you're employed there, you have to have a superannuation. You're not allowed any other exception. You can't say, hey, look, I'm an American.
Yeah.
Don't hit me with that because
So
it's a terrible deal for
If
me.
you're a temporary expat in Australia, employed by an American corporation for up to 2 years, that corporation can contribute to Social Security on your behalf, and you're exempt from superannuation. That's in the totalization.
So there is one small exception, but
Well,
otherwise,
that's part of the
That one small
totalization agreement, right, Karen? That's
Yeah.
part of the
What?
totalization
That's
agreement.
part of the totalization agreement.
Maybe
So
it'd be a good
temporary
moment, Karen, to
employees-
explain what a totalization agreement is. It's not part of the Internal Revenue Code, but it does have some impact on this. Could you explain that a little more broadly?
Well, basically, it's a Social Security agreement where countries agree to cross credit work credits so that you can qualify. So that generally you need 10 years in the U.S., 40 quarters to get Social Security. But if you worked in a totalization country, a country with a totalization agreement, you can use up to 6 years in that country to get your to get enough credits to get some Social Security to qualify for it. And
In other
the
words,
other way
you
around.
can use the work experience in both countries to
Right.
meet the requirement to qualify.
Right.
qualify for
Right.
If I may add with the totalization agreement, and please correct me if I'm wrong, is that if you're a self-employed person in a country that does not have a totalization agreement, you're obliged to pay self-employment tax to both countries, the US
Yes.
and the other country, correct?
Right.
Yeah, look at Israel. There's an example right there.
Right. So
Mhm.
hence double taxation.
Absolutely. No
Absolutely.
question about it. Look, anybody who says, all right, just pausing for a minute to inject this truism, okay? Anybody who says that Americans abroad are not subject to double taxation doesn't understand this at all. If your accountant makes that claim, find a new one. That's the first clue they don't understand this system at all.
Well, this might be a good time, John, to head over to your
Before we get there, I just want to add one
Sure thing.
You're talking about the corporations in Canada. Small business corporations are used as private pension plans. Okay, and this is with the blessing and encouragement of the government of Canada. So the transition tax comes in and literally confiscated people's pensions. confiscated people's pensions.
Oh,
Are you listening,
man.
Professor Hertzfeld? Are you listening? Okay, you know, and the other tax academics who frequently ignore this reality, confiscated pensions of individuals outside the United States, many of whom may never even have lived in the United States. That's what this is about.
Wow.
John, there are people that say that there are things individuals could have done to avoid the repatriation tax.
Well, of course, Professor Hertzfeld will be an example, you know, wrote that thing in tax notes. That is, frankly, one of the single most idiotic claims I have ever heard from anybody, let alone somebody who purports to understand these rules. First of all, okay, not even until the last day was it clear what the legislation was going to be that did this. Number two, do you seriously expect some average American citizen living outside the United States, perhaps running a dry cleaning business or something, if they could even find the kind of clairvoyant tax advisor who would imagine that something as depraved as this could possibly exist? I mean, that is so stupid that I think I've talked about it long enough. I don't even want to dignify it further. That is the type of thing that could only come from somebody who lives in sort of the world of theoretical possibility, completely devoid from the reality of anybody's life.
Well,
This
and
was passed like 7 days before the end of the year. You had like 7 days, and it was the 7 days between Christmas and New Year's
that's
to
right.
make any
Oh my God, that's right.
Many
That's
people
right.
Didn't even know about it. Didn't even know about it until well after. Interestingly, you know, Monty Silver, who many of you know, championed a lawsuit against the regulatory regime, part of the transition tax. I may be incorrect on this, but I don't think he even knew about it until in 2022 after it was passed.
Yeah, 2018. Yeah.
Or I'm sorry, the year after it was passed, 2018. So no, I think that is an absolutely absurd statement, Laura, that, well, people might through tax planning. If people were doing tax planning, as one commentator, one of my favorite commentators put, and this was in the context of the Moors, what the Moors would have learned was that, well, the law is that, if I'm a 10% shareholder of something that's called a controlled foreign corporation, meaning the total U.S. shareholdings are 50%, then to the extent that the company earns investment income, okay, a certain kind of income, some part F, that I might be responsible for that. But for the active business income, which the repatriation tax is all about, there was absolutely no indication that was going to be taxed. Now, I want to make this point that these tax academics have the temerity to actually call this deferred income, as though it was always supposed to be taxed.
Yes.
That is absolutely outrageous. There's nothing in the Internal
Right.
Revenue Code whatsoever that has a category of please note that this is income that we're going to tax later. It's either taxable or it isn't. And this income was not subject to U.S. taxation. Therefore, counsel for the Moors or anybody else, you went in to get a good tax advisor, would say, not to worry, this is active business income. It's not subpart F. It will be taxed only to the extent that there is a dividend paid upon receipt. So, Laura, that claim is absolutely idiotic.
John, I know you want to move on, but one more point on this. There's a couple articles published recently saying that individuals could have and should have avoided the repatriation tax by using an S corp.
Oh my God! Again, I mean, that's equally stupid. All right. So let's have a scenario. So Laura, I'm going to be the hapless shareholder, and you can be my lawyer for a minute, okay? And this is before, say January 1st, 2017. Hi, Laura. Thanks for meeting me. I know the time is running. You're a high biller, so I want to get straight to the point, okay? I've got this business going on, and I've been filing my taxes, and I've been filing my 5471s like a good, in fact, the best American abroad. I know of nobody who is more tax compliant than I am. Could you please confirm for me that, that my company that does dry cleaning we are going to open up a coffee shop right next door, and this is going to be part of our business so that people can drink coffee while we're cleaning their clothes. It's a new concept in this country that is not the United States. Laura, Ms. Snyder, could you please confirm for me that this new coffee business, and I promise that this is active business income, can you assure me that this business will not be taxed by the United States?
Well, knowing what I know now today, no, I could never assure you that. I absolutely cannot.
Under the current laws, now I know, Laura, that Ms. Snyder, I know that nobody could say with certainty where these laws might go. Maybe, you know what? Let's dial in Counselor Anthony Perrant, and where are you? Connecticut, to weigh in on this. Counselor Perrant,
Yes.
Here I am in Germany, and I want to expand my laundry business so people can drink coffee while I'm cleaning their clothes. But you think that's a good idea, Anthony? Sorry, Mr. Perrant.
Yeah, well, yeah. I mean, because that coffee could require more cleaning, so that's a great idea. That's called market capture. I love it.
Awesome. So you spill the coffee on their clothes?
Yeah, you got a built-in customer base right there.
Okay, thank you for that. So we know it's a good business idea. Now again, does this sound like active business income to you or investment income?
That sounds like active business to me. Very active.
So could you confirm? I mean, I had this consultant with tax guru Ms. Snyder, okay, but I just want confirmation because I am trying so hard to be compliant with my U.S. tax. Could you confirm to me that income, that new active business income from coffee stains with my German court, could you confirm to me that will not be taxed by the United States?
No, I can't. Well, are you a U.S. person? You are a U.S. person, so no, I can't confirm that.
Under the current laws, it's active business income. Are they going to tax me on the corporation's income directly?
It depends.
Well, hold on a minute. Counselor Snyder?
Well, normally the United States can't tax a foreign corporation directly. They can only tax it through the individual.
Whoa, let's pause on that for a minute. Miss Albert, Counselor Albert, is that a provision of a tax treaty that says that the U.S. can't directly tax the foreign corporation? Is that in the tax treaty?
I think it is. Yeah.
The answer is yes, it is. Okay.
Yeah, I think it is.
So in other words, isn't it true that what the United States is trying to do is tax income that they're prohibited from taxing directly under a tax treaty by making up the fiction that, the individual shareholder must have received that income so that we can tax it? Counselor Perrant, is that an accurate statement of what's going on?
That's exactly what's going on.
Oh my God. And Mr. Redmond, does that sound depraved to you?
I think you're screwed, Mr. Richardson. Yeah, it does.
My question is, so they say that an individual shareholder should have set it up as an S corporation. If I've got a German corporation that I'm running and I'm living in Germany, can I even set it up as an S corporation?
No, only domestic companies can be S corporations. You can't make an S corporation foreign.
This is another example of how the existence of overseas Americans is simply
hold
denied.
on. What you could do is create a U.S. C corporation and use the C corporation to form the S corporation, right?
Wow.
You're
pay Counselor Perrant more fees, right?
Yeah, there you go.
Yeah.
Right. Yeah, the few steps to it.
But then again, what's the tax situation and where you live from owning a U.S. corporation?
Yeah.
Well, this is another very interesting problem. I mean, it's not like only the U.S. has CFC rules. Now, they may have pioneered it. They may be the worst, the most abusive, the most vicious, and the most unreasonable, which is the American way. But make no mistake about it, Germany has CFC rules. France has CFC, Canada, a number of countries
Australia has
CFC rules. Australia, I know, has CFC rules. So you can't, as a resident, as a tax resident, say Australia or Canada, set up a corporation in the U.S. necessarily without running afoul of their own CFC regime.
And there's also non-tax legal restrictions on that. For example, if you're operating, say, a law firm or a doctor's office, the laws are going to be pretty particular that you need to operate that as a domestic company, not as a foreign company.
That too, for certain types of things.
Yeah.
Mm-hmm.
Do you think that Americans abroad live abroad to evade U.S. taxes? Does anybody think that? I mean, we're talking about a lot of expensive regulation here.
The thing is, John, most Americans live in countries that are normal tax countries, not tax havens. So, you don't, as we've said often, you don't move to France or to Canada, Australia for low taxes. That's absurd.
Right. Well, do we want to now, John, do you want to go over sort of quickly?
Yeah, sure. We can cover some of those highlights. I mean, these are just sort of things that explain kind of what the problem is. Move up to the top here. You can put the link to the post and that, but here's 10 categories of, now these are, okay. Now let me preface this by saying again, everybody's entitled to their opinions, but they are not entitled to their facts. Okay. And I would like to suggest that we've got 10 categories of indisputable facts here, okay, that are not subject, at least by anybody who understands this, are not subject to a great deal of interpretation. So let's begin. And this is the question of double taxation, right, in Americans abroad. Now, there may or may not be double taxation, all right? Sometimes there isn't, sometimes there is. But the key point is that things like treaty, foreign earned income exclusion, and foreign tax credits do not necessarily get rid of double taxation. All right, let's start. People say, well, the foreign earned income exclusion necessarily means there's no double taxation. Not necessarily, for one very simple reason, that foreign earned income exclusion applies to a very narrow category of income. It doesn't apply to all categories of income, including investment income. The investment income might be subject to double taxation, okay, which the net investment income tax would be one example. So, that's, I think the first point on that. Now, moving along quickly, then they will say, oh, the foreign tax credits. You get a dollar for dollar foreign tax credit for, taxes paid in other countries. Well, as Keith Redmond has talked about from time to time, I mean, that's dependent on it being designated by the U.S. as an income tax. And we've had this problem.
It also depends on the two countries defining the same things as taxable income.
At the same time.
At the same time,
yeah. At the same time in just 1 second. But it is simply not the case that all taxes paid in the other country can be used as foreign tax credits to offset.
Well, like gambling winnings are taxable in the U.S., but not in Australia.
Let's get to that in a second. That's not a double taxation problem.
True.
It's U.S. taxing income other countries don't. Let's make that a separate category. Okay, just focusing on double taxation, net investment income tax. It is written in the Internal Revenue Code as it's in the family of PFICs, CFCs, essentially to deny foreign tax credits to foreign investment income. Okay, plain and simple. It's designed to be a 3.8% charge on foreign investment income. Enough said, move on. Subpart F, guilty transition tax. Now, these are the things that we've been talking about the dry cleaning and coffee business, where what happens is that the U.S. attributes the income of a foreign corporation directly to a U.S. shareholder. Okay, and that's what the Moore case is about. Now, the reason that this results in double taxation, now listen carefully to me, is because of usually a timing problem. Because let's imagine that $100,000 of income, the U.S. attributes that income to the U.S. shareholder, even though it has not been distributed, okay, has not been distributed by the foreign corporation to the shareholder. So we have an attribution of the income, and we could do a full session on this, as ordinary income, by the way, okay, an attribution as ordinary income. The U.S. shareholder has to pay tax on today, but if 5 years later that income is distributed as a dividend in the other country, they will pay tax in the other country, amounting to pure double taxation. Now, there are ways, if you're really clever, okay, to mitigate and work around, but the fact is, and facts are stubborn things, that this does create double taxation. Moving on, we've talked about renunciation. The exit tax, the 877A exit tax, is designed to create a taxable event in the United States without an actual realization of assets. when there's a distribution or the assets are realized in the other country, you'll be taxed there as well. Pure double taxation. And by the way, I want to point out that this is particularly horrible with respect to foreign non-U.S. pensions, where the U.S. will basically confiscate it. Not a U.S. pension, but a foreign pension. Moving on. We've talked about the denial of the tax credit. Now, let's move on to part two, which Karen had a raise. Move up a bit, Anthony. Part two, move up. So this is where, now Karen gave the example of gambling winnings taxable in the U.S., but not in the other country. This isn't double taxation. I mean, this is what the tax gurus would tell you, and they're right. But there is an example of where the U.S. taxes thing the other country does not, which makes retirement planning very difficult. Let me give you an example. Okay, and by the way, these are not absolutists. Smart people can work around this, but we're talking about principles. Take a Canadian TFSA. It's like a Roth IRA equivalent in the U.S. Canada will not tax the growth. The U.S. will. Very clear interference with, financial planning. Again, the U.S. taxing it, the other country not. Another example, there are certain distributions from foreign corporations that may not be taxable in that country to the shareholder, but will almost always be taxable to the U.S. Next, deemed distributions. This is really the subpart F thing. We've already talked about it.
And I just want to introduce, when you see the word deemed, it means invented. That's another way to do it.
It means fake income.
It means fake
income.
Yeah. That's the other way to say it. It's fake income.
Yeah. We've talked about the whole issue of the Australian superannuation, right? And that is sort of a pension plan. I've seen examples of those can be treated as grantor trusts, et cetera. The point is, again, this is where the U.S. may tax something the other country does not. The PFIC taxation of non-U.S. mutual funds. Well, the way they deem the distribution as an excess distribution charge and not income does create interesting issues when you try to use foreign tax credits. That's why I threw it in there. Next, phantom capital gains on the sale of a principal residence, for example. U.S. deeming something as income that would not be income in another country. This is exacerbated by exchange rate problems. Part three, why tax treaties do not protect. And I would go further, they facilitate double taxation. I will say it again. U.S. tax treaties do not protect individuals from double taxation. They facilitate it. And this is, of course, because of what's called the saving clause, which in a general sense is, hey, buddy, U.S. citizens don't get the benefit of the tax treaty. We can always tax a U.S. citizen no matter what the treaty says, except in, certain areas. I'm not going to talk about double taxation. Then people say, this is one of the most idiotic claims ever to come out of the mouth of the basic tax preparer. Absolutely idiotic. Run. If your taxpayer says this, run. Get away from them. They don't know what they're talking about. They say the tax treaty prevents double taxation. Not at all. The standard tax treaty basically, without the additional type of thing that, France or Canada has, basically says, yeah, the U.S. will give a tax credit subject to U.S. tax laws, right? It's not generally an independently created tax credit, okay? So that doesn't work either. Bottom line, the big problem is the savings clause, which allows the U.S. to tax its citizens abroad, which really means the residents of other countries reaching their hand into the other country as though the treaty didn't exist. Next, Anthony. Penalty-laden reporting requirements. Now, this is part of the American tax system, and I would argue that it's a huge part of the system. We talked about Form 5471 for the small foreign corporation, $10,000 penalty. Don't disclose your assets to the U.S. on a Form 8938, $10,000 penalty. Don't report income from a foreign trust, whatever that is, penalty of 1/3 of the value. Received a gift from a foreign spouse, your spouse transferred, say, an apartment to you worth, a piece of real estate worth $1 million. Don't report it to the IRS, penalty of 1/3. Fortunately, no penalty for not filing the mutual fund form, the Form 8621. The real penalty is the expense that you pay to Anthony or somebody to create it. And then, of course, let's never forget Mr. F-Bar, the most brutal penalty thug on the block. We've talked about that. Yeah. Bottom line, without even regard to taxation, Americans abroad live life in the penalty box. Next, direct compliance costs. Well, I don't know, 8 or 9 years ago, I used to say the minimum cost to get a U.S. tax return done was probably $500. I'd put it up to probably $1,000.
Yeah,
And that's without
yeah.
any analysis. That's just running the stuff through a computer program. So you've got that cost. Now, that is $100 a month, that you have to set aside to file a U.S. tax return. It's not nothing. Okay, but then in addition to the return, the cost goes up with every additional information, penalty-laden information return I just described. In Toronto, it's common to charge $5,000 for a Form 5471, which is justified because if you took a look at the form, it's not a form, it's a collection of about 11 or 12 forms with schedules, and it's a more comprehensive corporate tax return than you'd file in Canada. Now, so I would say, it's like $1,000, but, incredibly, I was in Europe last week, and I spoke to somebody at an event who told me, and I asked him to confirm this, that he personally paid $40,000 a year for U.S. tax compliance to show no U.S. tax owing. Okay? Now, I don't care what your level of wealth is. I mean, that's insane. But the direct compliance costs, even at $40,000, pale in compared to Part 6. The indirect compliance costs here.
And honestly, that $40,000 could be a bargain. Because certainly we have some clients who, their fees get up there and they tell us like, well, you're half of what the Big Four charges.
That's right. Anthony is best.
I am the bargain, right? I'm the bargain. I'm a tax law firm who prepares this, and we happen to be the bargain at $40,000. Yes, it's actually true. It's
all right. Now we move on to indirect compliance costs. Now, one of the most indirect and insidious ones that people seem to not realize is, okay, so in the U.S., lots of people have spouses in the world, right? So if you're in the U.S., it's common for people to use to file jointly, okay? You want to file married filing separately, that's fine, but it's a more punitive filing category for a variety of reasons that I'll get to. But the point is that I know of no easier way to bring down a marriage, or at least, to invite your spouse into the U.S. tax system, right? So in the interest of family harmony and possible tax planning, okay, Americans abroad tend to use the married filing separately category. Now let's look at what that does. First thing is, this is a byproduct of the 2017 so-called tax reform, that an American citizen, okay, who's married and is going to file married filing separately, let's say, basically get this, they don't get the standard deduction, or they don't get, the thresholds for when you have to file that are generally tied to the standard deduction. They have to file with only $5 of income. Okay, imagine that. Okay, $5. Actually, the Internal Revenue Code says 0, but the IRS, and thank God, okay, who has at least put a $5 thing on it. All right, but you say, well, so what? You just file a return. Well, here we go. The requirement to file a return will then drag the Form 8938 into it, okay? And what that means is disclosing of, very often, okay, if it's done properly, the financial assets of the non-U.S. citizen spouse if they're owned jointly. So I'm sure Anthony, as a good counselor, would say, oh my God, you separate those assets. Okay, for sure, because otherwise, let's say one spouse, in the world, there are still spouses who stay home and, take care of kids and that's their, very valuable and important contribution to the family unit. I mean, they may not be bringing in money, but, they're sucked into this and that can easily suck in, okay, the non-citizen spouse. Next.
John, you see that in the survey. A lot of people who participated in our seat survey said that they've been cut off from their spouse's assets.
Absolutely. Absolutely. It's either that or divorce. Okay. Actually. Okay. Part 7. Property transfers to and from. Move up a little bit here. Part 7, Anthony. Okay. Stop. Now, this is really interesting how the U.S. tax system interferes very directly in this way in the marriage between a citizen and non-citizen. Okay. Now, a lot of this has to do with property transfers and that sort of thing. I think I already made the point earlier. I'll make it again. That a U.S. citizen who receives a gift from a spouse who's not a citizen or resident is subject to reporting if it exceeds 100,000, which is not much these days, and subject to high penalties if not reported. Right now, the reason they're subject to the penalty is because of the citizenship of the person they're married to. Right? I mean, this is so insane. Okay, but normally in U.S. laws, as presumably everybody knows, you can make transfers to your spouse back and forth, and these are not considered to be evil or reportable as long as they are two U.S. citizen spouses. But if you were a U.S. citizen, you want to make a gift to a spouse who's not a U.S. citizen, there's an amount every year that you can do so where you don't have to report it. I think it's approximately $170,000 a day. It's indexed to inflation. But anything above that is subject to gift tax reporting, and we know where that goes with penalties. Agreed? Next, Part 8, career and social costs. A U.S. citizen of family unit imposes, as I think I've demonstrated, both actual and opportunity costs on the family, okay? We've got the expense of compliance, and we have the problem, the loss of opportunity because the U.S. citizen is a member of the family in terms of retirement planning, etc. Which is why, as Laura points out, U.S. citizens are frequently not included on joint accounts in marriages and denied formal ownership in the family home. Now, think of this for a minute, okay? It is possible for marriages to go south. And there's a lot of unscrupulous, nasty lawyers who might advise the non-citizen spouse to use that as leverage, okay? So this puts American citizen spouses in what I'll call mixed marriage in a very precarious situation. I think
people die too. They don't just divorce, they die.
They die. Okay. Yeah. That's a separate category that I didn't include here, but we can do that in another podcast. All right. Next, we all know U.S. citizens have been barred from employment because of FBAR requirements. U.S. citizens may be denied bank and financial access because of FATCA. This is, again, a country-by-country thing. I know of a lawyer in London who's written articles about whether it's appropriate for U.S. citizens to renounce prior to a marriage, okay, as a condition of the marriage. These are interesting discussions. I'm not going to take a personal position on that, okay, but, this stuff is a reality. And I was once moderating a discussion at a tax conference where I asked a very, very high-end cross-border CPA the following question. I said, tell me, does U.S. citizenship taxation make a divorce between a U.S. citizen and a non-citizen far more expensive? He said, absolutely yes, probably minimum 3 times as expensive. Now, I would say that if you want to get under the $2 million to expatriate, divorce first to reduce your net worth. But in any case, Part 9. And now we get to one of the most insidious things that nobody even talks about. American citizens are prisoners to the U.S. dollar. They have to go through life tied to the U.S. dollar. There are no other citizens of any other country that do so. Now, this has very interesting compliance consequences. The first is because everything has to be translated to U.S. dollars, right? Now, everything has to be translated, but there are different rates of exchange for different kinds of transactions. I mean, this is like, you can't even make this stuff up. It's so incredible. For FBAR and Form 8938, okay, the exchange rate that you're required to use is the Treasury exchange rate on December 31st of the year. There are some people who don't even know if they're going to have to file an FBAR or a Form 8938 until into the next year when they learn what the exchange rate is. I mean, some people go on ski vacations. Americans wait at home anxiously waiting to see what the
exchange rate is. Yeah,
might
right.
have to report. Income, employment income, average exchange rate for the year, purchase and sale of a house or discharge of a mortgage. What was the exchange rate on the day you bought and sold the house, etc.? Now, this is unbelievable stuff, right? But these requirements of being tied to the U.S. dollar, being a prisoner to the U.S. dollar, can create gains and losses from a U.S. perspective that are not gains and losses from the perspective of the country of residence. We call these phantom capital gains. And I swear to God, that resident Americans will never know what it's like to live life as a prisoner of foreign currency, because that's what a U.S. citizen is, a prisoner.
You can lose money in local currency and still have a US dollar gain.
Yeah. And then finally,
and how do you pay your taxes? Because you lost money. You actually lost money.
You actually lost money. Yeah.
So you actually don't have the money. So right, exactly.
yeah, well, of course, and don't forget, okay, that this is not just the the gain or loss on the sale of the house; it's the discharge of the mortgage, right?
Mhm.
Because the exchange rate operates, so you end up discharging the mortgage, even though you actually discharge it in the currency where you live. If because of exchange rate fluctuations you discharge it with less U.S. dollars, that is all good tax people would tell you is a discharge of debt, which is taxable as ordinary income, right? So it's more fake income you never had. And part 10, because I know we're running a bit late here, but I think this is a good discussion. This is the single biggest problem of all. So let's pause for a minute. We can talk here like a bunch of, tax lawyers or something. And I'm sure after listening to this, it's exacerbated everybody's hatred of lawyers. Directed to Anthony, not to me, though. Okay, thank you. No, I'm only kidding. I'm sure it's exacerbated your hatred of lawyers. But this is what most advisors don't understand. And there's a great discussion going on Twitter right now about this. It's the fear of penalty and uncertainty, the anxiety of being asked to comply with rules in a country you never live in, that you cannot understand, that you're very lucky if you can find an advisor who understands this stuff well enough to explain it to you, etc. And it's the uncertainty that kills people, the uncertainty, the fear, and this is what makes people do stupid things. I was in a discussion last week in Europe. Okay. It was sort of a group discussion, and I've rewritten this a little bit. Okay. So these weren't the exact words, but it does capture the sentiment. After the discussion, basically somebody came up to me and basically said, I was watching this and I was just so struck by, this one person in the meeting who, felt that she had to renounce her citizenship because she was so scared and so incredibly tormented by the whole situation. And then she looked at me and Jesus, I think I understand. I get it. Okay. And the empathy. Okay. I think certainly better than 99% of people. But then she said to me, and this really irritated me. I mean, it really hurt me actually. She says, I don't think you understand how bad the psychological impact and fear really is. Try to understand how we feel. Oh my God. For years, I've specifically not made a living as opposed to making a living, specifically not made a living. Because of my understanding of how horrible this is for people. All right. And this, ladies and gentlemen, is why not only people renounce, but they don't want, they renounce not because they want to, but because they feel they have to.
Yeah. There you go. Thank you, John, so much for that. And I mean, here you go. So what do you guys think of this? Now, do you understand why this article? I mean, John, what a takedown of this article, and I think what a takedown, of Senator Gillibrand. Here she is. This, not understanding the issue whatsoever, and we were talking about this, and I think this might be a good place to end it here. Well, we're gonna have to because we're nearly out of time, but really the issue. Yeah, go ahead, Laura.
Could I make a kind of a concluding statement to what John just said?
Absolutely.
I want to follow up. John says, you're entitled to your opinion, but you're not entitled to your facts. And I think that you have to look at that summary of what John just gave us of all of the issues that overseas Americans face. And here is a way to look at it that is factual. The United States singles out people whose nationality is the United States and targets them for treatment that is different of people who have any other nationality living outside the United States. The treatment is different and it is worse. And if you look at 100 years worth now of equal protection cases by the U.S. Supreme Court, it is crystal clear that nationality on the same on the same level as race is a protected class subject to strict scrutiny. It is something that the Supreme Court has said in repeated opinions. Discrimination based on nationality is to be treated with antipathy, and it is un-American. That's not the word they use, but that's essentially the word they use, is to be treated with antipathy. And you even have a recent case of the affirmative action case of Students for Fair Admissions, where the majority opinion and concurrent opinions are very clear that nationality and race are, well, races are subsets of a nationality, or nationalities are subsets of race. Whatever it was, they are really inextricably linked, and they are both prohibited under the 14th Amendment Equal Protection Clause. And so it is not an overstatement to say that the United States discriminates against its nationals living overseas. It is not an overstatement to say that this violates the Equal Protection Clause of the 14th Amendment.
It's actually the Fifth Amendment. We don't have state action.
Well, there's the due process of the
due
Fifth
process of
Amendment,
Fifth
which
Amendment, but which is
applies
an
to-
right, which is just
Yes.
yeah. Sure.
Yeah, the shorthand discussion is the 14th Amendment.
Yeah.
Otherwise, you get people confused.
Yeah. There I am confusing people right on.
Anthony,
Yeah.
could you put up that tweet that I sent you on the renunciation
I
issue?
sure can.
You know, because I think this really sums it up. People are not renouncing because they want to; they feel they have to. The other one I sent you this morning.
That wasn't it.
No, check your email from
I'll check my email.
before we started here.
Oh, the one earlier this morning.
Just before, well, after we got started talking, I sent you the tweet.
Yeah, that was it. I think.
No,
Yeah. All right. You say something. This is the one I'm just clicking on right here. So this is what we're getting. Whatever it is.
yeah, there
Okay.
it is. That
Here,
right
okay.
there. I've seen people. Yeah, look, this is my experience. Okay, I mean, I've been helping people, or at least trying to help people the best of my ability with this for years and years. But you know, I always get up early, and you know, and this was part of a discussion this morning. But you know, I really had to throw this into the conversation because I am convinced that the only people who can really understand this, all right, are the people who've been affected by it. But this is the honest to God truth, okay? I've seen people in tears entering the consulate to renounce. They knew their birthright had been stolen from them. They felt helpless, betrayed by the United States. They realized they were the victims of a scam when taught the USA was a kind, just nation, and they'd filed taxes. You see, filing taxes is the first step to renunciation, really, right? But they went ahead and renounced anyway. And Anthony, I sent them the Dodge Stratus podcast after that.
You did. They upgraded right on. I wanted. Thank you. So I just want to. We're going to wrap up. I just want to get any concluding remarks from Karen. Karen, what would you want to add before you go to your well-deserved rest tonight? Thanks for staying up late for us.
No, I think John and Laura have covered it pretty well. And I think it's important to realize that just because you might not have any problems with U.S. citizenship tax doesn't mean nobody does. And there are all the different types of people, U.S. people living abroad, and they're living in different countries, and everybody experiences it differently.
There you go. Yeah, then I think I'll
Absolutely.
go with there, Keith. If you could just put the bow on that, and you go ahead, Keith.
I just have one statement. I think this is an excellent podcast. I think any journalist who's going to write about Americans overseas and the taxation issues needs to listen to this podcast to get their facts straight on the reality on the ground. Full stop.
There you go. Beautifully said, Keith. And I really want to thank all of you for joining us today and really getting the word out here, because I can't think of a better way. Yeah, we went a little longer than we did today, but the amount of information we packed in, I think, demolishes the narrative that we're led to believe that, hey, everything's honky-dory if you're overseas. Don't worry about it. And actually, it even goes worse than that. They'll even claim you're benefiting by living overseas, which I think we've proven for most situations that's the furthest thing from the truth. The question is what do we go from here? Where do we go from here? And that's what I think, we're hoping that people share this podcast, really disseminate what we're talking about here. And what we notice is that these people who write these articles, you know what, when you try to get back to them to say, here's the truth, you know what they do? they ignore you. It's as if you don't exist. So how are we going to make people understand that we exist? And this is what I would say is that we all need to unite. You know, in that every situation, the tax situation is different. You may live overseas and have an easy time. It might not be that bad, or you may be utterly hammered, or you may be living in the US and have nothing overseas and you could be hammered. The thing we all need to look at is who is asking for this tax code? Who is this constituency? Who is the constituency that wants to be ruled by totally idiotic rules that are impossible to understand and devalue everything about humanity? Who would agree to this? And seems more rather that we are captive of the U.S. tax system as opposed to something that we consent to this. It's far, far divorced from what anything everyone wants. And it's something like this where we have people like Kristen Gillibrand asserting that the real solution to this utterly overburdened tax system is more of it. And this time for sure, we're going to get the rich. And so I ask all of you to say, not to fall for that rhetoric that leads to the disaster of which we're in today. The reason why we're in this disaster right now is because the income tax promised to only impact the rich. But now we see, well, it's a funny way of impacting the people who don't have the resources to protect themselves with fancy lawyers to create structures for them that they hammer them. So with that, I want to thank you all again for joining us today. We've had great comments and great interaction and a ton of packed content. So be sure to subscribe and turn on your notifications so when we go live, you can participate. And we will be covering Moore versus U.S. I think that's going to be a fantastic podcast. Really, one of the most important cases that ever will be decided by the Supreme Court. So be sure to do that and also spread the word. This is Anthony Parent for Laura Sider, Karen Albert, John Richardson, and Keith Redmond. Thanks for watching.